makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The ECB President Christine Lagarde is expected to push back on rate cut expectations in the central bank's first meeting of the year, with policymakers expected to hold borrowing costs. We're live in Frankfurt. Well, Tesla shares slide after it misses on fourth quarter earnings and warns of weaker sales growth for the year ahead. And also coming up in our weekly UK show, as elections loom on both sides of the Atlantic, we'll look at the impact of a resurgent Donald Trump on Britain. So let's take a look at the European markets map. The picture overall is, of course, one where markets are trying to digest a lot of the earnings that we had. A lot of the focus will be on what we heard from Tesla last night. So stocks overall falling a touch. Again, there's, I guess, the buoyant mood that we had in the last couple of days really being subdued, as also investors look forward to a meeting of the European Central Bank to see if Christine Lagarde pushes back against market expectations. We also have economic growth out of the U.S. Just on Tesla, it did drop 6% in after hours yesterday, and this is after the electric vehicle maker missed earnings estimates and also flagged slower growth this year. A couple of other things we're watching out for is some of the other earnings, and also U.S. data expect to show that the economy expanded at 2% annualized rate in the fourth quarter. Now, the other piece of news that we have, and we'll be speaking to the Ifo president shortly, is that January Ifo confidence, business confidence coming in a touch below expectations, 85.2 instead of 86.6. Remember, we had a pretty spectacular panel in Davos last week, where also Christian Lindner, the finance minister, said that Germany is not the sick man of Europe, it's just the tired man of Europe. But later on, we'll be speaking to Clemens Fuest, the president of Germany's Ifo Institute. That interview, 9:20 a.m. UK time. So the European Central Bank expected to keep borrowing costs on hold for a third meeting today. For more, we go to a correspondent, Maria Tadeo, who's live at the ECB in Frankfurt. Maria, good morning to you. So I guess market expectations is what Christine Lagarde could really push back against, is cuts further down the line. But we're not expecting really anything big today.
Yes, Francine, and when it comes to the actual monetary policy decision, as you say, it's a hold, it's unchanged for the third consecutive meeting. We see this theme of higher for longer at the European Central Bank. But again, as you repeated, this is about the forward-looking expectations from the central bank. We know that this year there will be cuts to come. The question is when. And on that note, look, we've had two big clues already. One obviously involves you, because it's your interview with the head of the ECB in Davos. She said highly likely, that was a quote, we could see a move down in the summer. That was the first indication that we had from the ECB in terms of the timeline, but also the Governing Council around the head of the ECB before the quiet period, also pushing back against expectations of an early rate cut. Remember, the ECB has been trying to almost push back on markets this idea that you could see one in Q1, almost hinting that no, they will look at a data that would encompass almost the first half of the year. So a lot of this will be about the calibration of the timing of those cuts. So it will be about the language more than the actual decision itself, which, as we know, it's probably going to be another unchanged move from the ECB. But when do we move from here and when do we do it will be the key for the central bank.
Yeah, which is basically, that's why it's all eyes on the press conference, right? Because that could be the more relevant bit, Maria.
Yeah, absolutely. And it will be about the press conference, and it will be about whether or not she doubles down again on this idea of summer is the landing zone for this central bank. And it'll be interesting, too, to see whether she repeats, because remember, when it comes to inflation, she's almost said we're not there yet in order to declare victory. If they do, obviously, that would indicate that rate cuts are coming next. But I'll be interested to see whether she alludes to the chaos that we're seeing in the Red Sea. Is that going to be an upside risk for inflation? And remember, one of the focus points for the ECB has been about wage negotiations and wage inflation. Is that something that she still considers is an area they have to monitor, and in place that already, well, they're not there yet in terms of bringing inflation closer to target on the medium term? That will be the key in terms of the data that they say they monitor before making the next move.
Maria, thanks so much. Maria Tadeo there, of course, at ECB headquarters in Frankfurt. And as always, we'll bring you live coverage of the ECB's policy decision. That's at 1:15 p.m. UK time. The news conference with ECB President Christine Lagarde half an hour later. Now, for more on this and what's moving the markets, I'm delighted to be joined by the Managing Director and Global Chief Investment Strategist at BlackRock, Wei Li. I mean, it's a good day because it's ECB day. It's an even better day when Wei Li comes on to talk to you about it. So, Wei, thank you so much for joining us. I guess the concern with the markets is that a lot of the good news about possible cuts has been priced in at the end of last year. So what will be the main driver for markets?
Well, understanding how far and for how long this narrative of immaculate disinflation can run is likely going to be driver for markets and risk sentiment for this year. So if we think about the Fed, and we can move on to ECB in a bit, but if we think about the Fed, the December pivot essentially greenlit markets to run away with this immaculate disinflation narrative. We think inflation will fall. In fact, at some point in the US, we think that it could get to target towards the end of this year. But we think that inflation will then rebound because of persistent wage pressure. But markets can only focus on one thing at a time. And evidence of inflation rebound is not going to be clear anytime soon, maybe not in the next 6 months or so, which is why we think that there's room and runway for this immaculate disinflation narrative to run, which is why momentum can continue for a while before we think about kind of resetting to fundamentals.
But so, wait, what does this mean? That actually the Fed and other central banks will be very careful in cutting in case then they have to hike, which frankly would hurt their credibility? Or does it mean that we're going to just get less cuts than's priced in the markets?
We think that we're going to get less cuts than what's priced in the market, especially in the case of the Fed. And we also think that we're going to get the first cut later than what market seems to be hoping for. I mean, today is the ECB day. We'll see if President Lagarde pushes back again on the rate cut timing that currently is looking to start in April. You know, like we still see kind of persistency in terms of the tight labor market, low productivity. Maybe they want to wait until the spring wage negotiation to be comfortable that inflation is indeed falling down durably, and that actually puts it kind of close to the summertime, which is the indication she has recently given out.
So, wait, is there a danger that actually, again, the ECB and other central banks need to push back even harder against markets because otherwise it hurts their transmission mechanism? It's almost like a feedback loop.
Actually, transmission mechanism and how they speak to it will be a key focus area as we think about what to pay attention to from today's ECB meeting. I think they will push back against markets pricing, but probably not too much. And in fact, if they push very hard on that, and given for now the macro backdrop is likely going to be characterized by falling inflation, we would actually lean against that. So it's a very delicate dance and delicate balance between kind of market pricing and central bank narrative and the wildly swinging narrative from time to time, which is a pattern that we saw for the entirety of 2023 that we expect to continue in 2024.
I have a lot of questions on earnings, which we'll get to in a second, but the BOJ is fascinating. And I don't know whether, I mean, this is going to be one of the biggest monetary policy experiments after the last 10 years. How are you expecting that to develop?
We do see them exiting the very loose and low monetary environment, which stands in sharp contrast to the rest of developed economies. But they are going to do that very slowly and not try to upset and disturb kind of the market stability around it. So we think that they are going to start hiking in Q2, but gradually and slowly, which is why we think that there is still more room to go in the Japanese equity core, which we like very much. We upgraded Japanese equities twice already last year. We still hold the overweight, but we like it on a currency unhedged basis because of the policy divergence closing a little bit as they now kind of join the party of rate hikes.
Thank you so much. Wei Li, of course, stays with us. We'll have plenty more from Wei Li, Global Chief Investment Strategist at BlackRock. We'll go through some of the earnings and we'll focus a little bit more about some of the main drivers for these markets into 2024. Now, also, Tesla shares continue to slump. Pre-market trading after fourth quarter earnings fell short of expectations. And also, the EV maker warned of weaker sales growth in 2024. Now, the chief executive, Elon Musk, has failed to convince investors to overlook slow growth. More on Tesla's outlook coming up. This is Bloomberg. So Tesla shares slumping after fourth quarter earnings fell short of expectations. The EV maker warned of weaker sales growth in 2024. Now, during his earnings call, the chief executive Elon Musk tried to soothe investor concerns or rally them really about slowing demand, teasing a new low-cost car. Well, we're now joined by Bloomberg's Oliver Crook. Ollie, so good to speak to you. I mean, I feel like Elon Musk is really trying his best, but investors are just not buying it yet.
Yeah, the way that he put it is that Tesla right now is between two immense waves of growth. And for investors, that's not always a very comfortable place. And what he said is that growth is going to be slower this year. It's slower than it's been historically. And they delivered 1.8 million cars last year. Now analysts are saying that they might deliver 2.2. That's still 20% growth. And that's not nothing in an environment where the auto industry is dealing with a lot outside of EVs. There's questions about EV demand more generally globally. Obviously, there's this slowdown in China. But he was also talking about the Fed rate. He was saying that basically our margins are pegged to the Fed. If the rates go down, our margins will go up. If they don't, they won't. Simple as that. And there's also the question of the Chinese competitors. So listen, you lose about 6, 7, 8% off of Tesla overnight as a consequence of this. But, Francine, as we always say, context is everything. This is a stock that is up literally 1,000% over the last 5 years. It is the fourth best performer on the S&P, and it's got a market cap of almost $7 billion, bigger than any company in Europe. So, all things considered, not so bad for Tesla.
Yeah, I think a couple of the analysts are saying, look, the outlook was also just too vague. Oliver, thanks so much, as always, with some fantastic reporting. Oliver Crook there in Berlin. Now, still with us, Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Wei, when I look at a lot of the earnings, so without focusing on one specific, company, valuations in certain sectors may need to come down this year, maybe.
Valuations may look stretched in the context of rates staying high but likely going to come down. But actually, earnings momentum is what matters for the immediate term. In fact, over the 1-year horizon, valuation matters, but not as much. Over the 5-year and 10-year horizon, valuations matters a bit more. So when it comes to earning, if we look at the AI theme, the tech sector, they are still expected to drive more than 50% of the low-teen growth expected from U.S. equity market so far this year. And you and I were both in Davos last week, and what struck me is how much AI is being talked about, not in the context of the tech sector, but thinking about the interplay between AI and other sectors, what it is doing for healthcare, what it is doing for climate transition. So when we bring all of this together, we have the conviction that we're just getting started in terms of the adoption of AI across sectors and benefiting companies with pricing power, companies with a lot of data to play with and to have economy of scale. So we do think that momentum can continue in the current environment for the Magnificent Seven and the tech sector, but maybe even broadening out a little bit as we think about what it means for the other sectors.
Yeah, and I guess and you're right. In Davos, it was crazy. Promenade, there were like 6 or 7 stands, and it's usually a good indication or sometimes counter-indication of really the sectors that are doing well or that will do well. But if you have a lot of, some of the big companies or some of the big sectors, do valuations triple if they get AI right, or do they actually shrivel if they don't? Is it like an end-all, be-all?
I think a lot of companies, as we go through this current earnings season, they all talk about AI. They all talk about how it is impacting their future profitability. So actually, it takes real expertise to identify kind of projects and companies that are really having value accretive projects based around AI versus those that just talk about AI, which is basically everybody. So I would even say that the era of generalist investing when it comes to AI and other mega forces that we identified is perhaps over. It really takes deep expertise to identify those projects, which is why, as we think about kind of the next wave of AI investing, greater selectivity, thinking about different stacks. We had the chips and the semis, but data center, infrastructure center, and then the actual applications of AI that becomes more relevant.
Wait, when you look at some of the geopolitics, and again, it's very difficult to see the big market forces in the markets for the next 6 to 7 months. Like, how do you look at geopolitics and I guess, the crisis, chaos possibilities that would really impact markets? Largely, they've looked through it now.
What we have developed within BlackRock is a geopolitical risk indicator which pays attention to how much geopolitical events are being picked up by brokerage research, by news reporting, and attention is now increasing. And we do think that we're in a new geopolitical regime where if you look at the percentage of trade out of the overall global GDP growth, it's stalling, right? So thinking about kind of the US-China relationship. So we're in a new geopolitical regime. Attention being paid to geopolitical events is increasing, but geopolitical risk premium as priced in by markets is quite flat. And I think here markets are applying an old playbook, which is whenever something goes wrong on the geopolitical front, you just buy the dip because very quickly things kind of recover. But in the context of the US-China spheres of influence moving further apart, we think that being selective instead of kind of automatically, indiscriminately buy the dip is the new approach. So geopolitical risk premium across the board is still quite flat, but certain parts of the market may want to bake that in a little bit more.
So interesting, Wei. Thank you so much, as always, for joining us. That was, of course, Wei Li, Managing Director and Global Chief Investment Strategist at BlackRock. Now, coming up, we'll also be talking to the Ifo President as German business expectations worsened for a second month. Wrong footing analysts. So we'll talk about that next. And this is Bloomberg. While Germany's Ifo Business Confidence Index fell in January just as economists expected a rise. The expectations gauge also fell in January, adding to an already tough start to 2024 for Europe's largest economy. Well, I'm very pleased to be joined by the president of the Ifo Institute, Clemens Fuest. Mr. Fuest, thank you for joining us. So Germany definitely narrowly avoiding a recession in the last few quarters. Has it now become inevitable that the downturn will persist?
It looks like that. So the data that came in today is certainly a setback, and it's a setback. It's negative data almost across the entire economy. The manufacturing sector is one exception where the data is more stable and things look a little better. But even there, companies are telling us that new incoming orders are low and increasingly a worry. So it's not looking good.
So what does it mean going forward? What's your biggest concern? Do you think actually we'll be in a recession in the first quarter? Will that be negative?
I think that is very likely now. We actually expected a positive first quarter, but with this incoming data, it now looks like it could be a negative growth rate in the first quarter, and that will have an impact on the entire year, of course. Our last forecast said that the economy would be growing at 0.7, and that's increasingly unlikely now with this data. The trouble is we have a very weak reading from the very important services sector now, something that we didn't expect. The positive aspects of the outlook, maybe declining interest rates in the second half of the year, rising wages, all of that doesn't seem to bring a lot of confidence. So the outlook is bleak, certainly for the first quarter.
But we've been waiting for a recovery in the German economy for actually quite some time. What exactly is holding it back?
So what we see in the data is an uptick in uncertainty. We ask company how confident are they that they understand their business outlook, and uncertainty has been growing. We also see in the data that Germany at the moment is an outlier in terms of policy uncertainty. So it seems that the economic policy, the German government doesn't really have a convincing plan about how to address the challenges that have been around for some time. The government has been very busy addressing short-term problems, gas supply and things like that, and has managed that reasonably well. But what's missing is a plan for the medium term, a growth plan. Germany faces a number of problems. Our most important sector, the car industry, is in a phase of transition, of structural change. Our energy-intensive industry, the chemical industry in particular, is suffering from high energy prices, and there seems to be little in terms of a convincing plan of how that can be addressed.
But I guess the expectation is that consumers, Mr. Fuest, could drive a lot of the rebound. Wages rise, inflation goes down. What if this does not happen?
This was one of the hopes for this year, and in a way it's puzzling that consumers don't seem to be spending, although their incomes are rising. So maybe that could be something that comes later in the year, but it could also be that if consumers are also feeling increasing uncertainty about their economic situation, they might hold back spending and save more, and that could add to the gloom in that case.
Mr. Fuest, how worried are you about labor productivity growth? It's been losing momentum.
It's been losing momentum, and this is a key challenge indeed. One of the reasons it is so low could be that bureaucracy is increasingly problematic in Germany. So the burden of bureaucracy means that increasingly companies have to let part of their staff deal with complying with regulations and bureaucracy, and a lot of that bureaucracy seems unnecessary, seems exaggerated, and I guess that's one factor holding back productivity.
Thank you, Mr. Fuest. Clemens Fuest there, the president of the Ifo Institute, live in Munich. Coming up, our weekly UK show, the Tories, Donald Trump, elections on both sides of the Atlantic. We have the UK covered. This is Bloomberg.